which offers loans through the Small Business Administration, the SBA, for those businesses that qualify. And currently this funding is set to cap out at $350 billion. And actually later on in my slides, you'll see that they actually did exhaust those funds yesterday morning for this initial funding. But due to high demand, Congress is currently considering additional funding for the program. So people should still look into possibly applying for this, because it's highly likely that they will be, I guess, approving more funding sooner than later. So the beauty of this program is that these loans that everybody is getting, the proceeds, if you use them according to the stipulations, which we'll talk about, the loan has the ability to be completely forgiven. And then on top of that, not only is it forgiven, you don't have to repay it, but it's completely tax-free, which is different than typical. Normally when there's a loan and you get a loan forgiven, you have to recognize the cancellation of debt income. But in this particular instance, they have allowed relief, and it's completely tax-free as long as you follow very specific guidelines, which we will discuss. So here's some basic information about these loans. The primary purpose is to pay the employees, thus the name Paycheck Protection. They're trying to avoid the unemployment claims from being as high as they could be. And it's also going to offer limited help with some other critical costs that these businesses will have that'll be explained later. The dates that these loans are available is the covered period, which is February 15th of 2020 through June 30th of 2020. Like I said, unless there's additional funding, it was exhausted. People need to get out there immediately and try to find a bank that is still, if once the funding gets refunded, that they're still accepting applicants, because I know I have several clients that were already approved, like they were approved 2 days ago, and then they got notified yesterday that the funding wasn't going to come through because the funding was exhausted. So they're still, quote unquote, in line. So people need to get in line. And where they can do that, they apply through their banks. The banks has to be an SBA approved lender. You can find those lists on the SBA website, and later on at the end of this slideshow, I actually have a link to the SBA website. So, and actually I think, because I looked at the Woodlands Chamber's website as well, I think they have a link up there as well. So applicants are encouraged to reach out to the bank that they currently have an existing relationship with first. If there's no relationship with any bank, then the applicant should search for an SBA lender, but just make sure that that bank is taking new customers for these specific applications. Some of them are not. And also, even if you have an existing relationship with a bank and that bank for some reason is not responding quickly enough to you, find one that will respond quickly to you, because again, time is of the essence here. It's first come, first serve. So once they start that funding again, it's going to go very quickly. When to apply now? Funding is limited, it's first come, first serve. It's based on the dates above, the February 15th through June 30th, but I mean, they were fully funded, $350 billion in just about a week. So I would assume that the additional funding that gets released will be fully funded very quickly. Again, Congress is discussing additional funding, so the borrowers need to be first in line with their lenders. Who should apply for these loans? It's primarily going to be small businesses, less than 500 employees. We're going to talk about the eligibility because there are some exceptions to those less than 500 employees, but then also this also applies, you'll see in the eligibility slide, to self-employed individuals as well, and nonprofits and such. So we'll get to that on the eligibility slide. The maximum loan that's available to each business would be 10 million. Of course, that's assuming that they can get to the 10 million. If you'll see the calculations later on, if it's in excess of 10 million that those calculations would get, then they're limited at that 10 million. And then afterwards, the loan forgiveness, once you have the loan, once it's funded, there's an 8-week period, and it actually has been determined that an 8-week period actually starts the day that your loan is funded. You have to be able to make payments that qualify for the loan forgiveness, and we'll get into those details later. The interest rates on these loans, if they're not forgiven, would be 1%, which is a very low interest rate. It's very attractive to the businesses, even if it's not forgiven. The payment terms, if for some reason it's not forgiven, they're to be repaid over 2 years, but they do have an initial 6-month deferral period. Let me just state right now, because if you were to look at the Act, you're going to see some sort of a reference to 10 years. I will just tell you, and perhaps some of you have seen the news, but what the Act says on all of this versus what the SBA is giving guidance on has been, they've been doing this so quickly to try to get this rolled out and out to everybody who needs it as quickly as possible. The Act sometimes has some very different things than what is being updated, and they're giving facts and they're giving interim rules. And so like I said, the original Act does reference like a 10-year period, but then when they gave interim guidance on the U.S. Treasury's website, they specifically said that they determined that due to the fact that they believe the COVID will, everything will be kind of back up and running within that 2 years, they believe the 2 years is sufficient to repay these PPP loans. The other beauty of this is no collateral is required. There's no personal guarantee. The businesses, they don't have to personally guarantee these loans. There's no prepayment penalties, and there are also no other typical fees like they have a lot of times, guarantee fees, annual fees, none of that. So they're very attractive loans for individuals, self-employed individuals and small businesses to try to get. So now we're going to talk about the eligible borrowers who can apply for this. So the official term is called a small business concern. It's basically the business that's eligible for this loan is a business, a nonprofit organization, a veterans organization, or a tribal business concern if it employs not more than the greater of, so 500 employees. There's also some, I wanted to put in there, there's a caveat, it has affiliation rules related to it. Those get a little bit more complicated. And if anybody has questions on some of that, they can definitely reach out to me, but I didn't want to bombard some of those calculations into this presentation today. And then, so it's not more than the greater of 500 employees, or if the applicable, the size standard in the number of employees established by the SBA for that industry that the applicant operates. So what that means is that the business can have more than 500 employees if their industry is in a specific industry that the SBA offered guidance that they have specific employee-based revenue or size standards corresponding to that industry. And I put the link on there so that you could see, you could go there and see if that particular business qualified for that. And then additionally, they also said that as of March 27th of this year, 2020, there's an alternative size standard. So even if the business had more than 500 employees, as long as their maximum tangible net worth of the business is not more than 15 million, or their average net income for federal income taxes, excluding carryover losses, for the 2 full years before the application was not more than 5 million, you would still be that small business. Also, the small business for this definition includes sole proprietors, independent contractors, and eligible self-employed individuals. And then another thing that it said was any business with less than 500 employees per physical location, if they have the NICS code of 72. That's their basically their industry code for, and that 72 is accommodation and food services. So these are going to be your hotel chains and your restaurant chains like Panera Bread and stuff. Even though they have more employees nationwide, at that physical location, if they have less than 500 employees, they are also allowed to apply for the loan for that physical location. Additionally, your employees, they all have to have a principal, for the employees to qualify within this loan, their principal place of residence, they must be in the United States. And then they also, obviously the business cannot be an ineligible business for any SBA loan. And I put a link on there that people can go look. That's going to be like, here's an example of that would be your cannabis businesses that are legal in states like Colorado. But for federal purposes, they are an illegal activity. So it is not going to allow you to get a loan. That business would not be eligible to get this PPP loan. And then in addition to those eligibility requirements, the applicants, when they actually go online, all of these, keep in mind, we're all still social distancing. So the banks, it's not like you can just go in the bank and pull up a chair with your banker. Most of these banks are gonna have, they're gonna have their remote access applications through their websites. And when you log in for that, they're all gonna make you certify that the borrower, the applicant, was in operations as of February 15th of 2020. They're also going to make you certify that you have some sort of current economic uncertainty that makes the loan request necessary to support the ongoing operations of the applicant. That is almost everybody. I can't think of anybody that has not been affected by COVID-19. You've got even if you happen to be an essential business, you have employees that aren't able to make it because they're sick, or they have kids that are home from school because they can't go to school. It feels like everybody has been affected. So there's probably not many that could say they weren't affected. The applicant also cannot have received another PPP loan, because you do these through the bank, so you can't go to one bank and get it and then go to a different bank and get it. They're not going to allow you to do that. And then you also have to certify that you're going to use those funds to retain workers, maintain your payroll, or make business mortgage interest payments, lease payments, and utility payments. Now note, when you're getting this loan, it doesn't give you stipulations like you have to use this for 25% or this for, so just to get the loan, you just have to say you're going to use it for these items. Now, the forgiveness is a whole different story. We'll talk about that in a little bit, but just to get the loan, you just have to say you're going to use it for any of these, and it doesn't matter what amount you use it for which. So when you apply to get that maximum loan amount that you'll be allowed to, you're going to look at the lesser of, again, the big numbers, the 10 million, but most people are going to look at their average monthly payroll costs. And we're going to talk about what payroll costs are in a minute. And the time period, like I said, there were so many clarifications to this bill. The time period was a big thing, because in the bill itself, it actually says previous 12 months. But then the SBA's website had said, okay, well, you can use the calendar year. And everybody was like, well, which is it? So they came out with guidance that said that you can use either the previous 12 months or the calendar year 2019. So you get your average payroll costs, you multiply it by 2.5 because that's what they're allowing you to do. But then you also have to add, because there are several other different loans, disaster loans out there right now. So if you got a disaster loan under Section 7B2 of the SBA, which is essentially that they refer to it on the news as the EIDL loans, EIDL. They were given out like a $10,000 advance, of which they didn't have to repay that either. It doesn't mean the loan that it was tax-free loan forgiveness, but they don't have to repay that. But if you got that, you have to add that amount, that loan amount, not the advance, but the loan amount into this maximum loan amount calculation. Because those came out before the PPP loans came out. So that's why you're basically refinancing it into this loan. And then, so they also have to stipulate, what if you have a new, what if you have a new business? So if you didn't have business activity during the time period of February 15th of 19 through June 30th of 19, then you're allowed to use your average monthly payroll cost from January 1st of this year, 2020, to February 29th of 2020. And then you would do the same thing. You multiply that by 2.5. Then they also have to talk about, you have seasonal employers, let's think here in our community, there's like Splash Town, right? They're a seasonal employer. So they're not gonna have the big cost, during some of these periods. They're gonna allow them to use their average payroll determined by using the 12-week period beginning on 2/15 of 19, or if they elect, they can use the period of 3/1/19 through 6/30 of 19. So now we're going to get into defining what these payroll costs are. When we're determining the maximum amount for the loan that you can qualify for, payroll costs, this was a very tricky subject as well. There was a lot of back and forth, and again, they finally issued interim rulings for guidance on this. So it was determined that you're going to look at your gross salary, wages, commissions, or similar compensation. That includes your cash tips, your vacation, your family leave, your separation pay, all what's in your gross payroll. That's what you're looking at. And typically most people are going to be using their 2019 just because it was easier to pull all of those payroll reports. Most people didn't have their first quarter 2020 just yet when they were applying for this. Now, when you look at that gross number, you're only allowed to use up to 100,000. So there was some question there because the way it was worded, it almost sounded like you couldn't use the employee if they made more than 100,000. But they did come out and add guidance that no, what they're saying is that you can only, it's a cap at 100,000. So you can still utilize those employees in the compensation. They're just capped out. And then actually just recently, this week, they brought up that for partnerships, because this was a big question, and the banks didn't know what to do because the SBA hadn't given guidance on how to treat this. They clarified that for those partners that have self-employment income, their general active partners, their guaranteed payments are all treated as self-employment income. They qualify as a quote unquote employee as well in these payroll costs. So those partners would not file their own PPP loan. You would file it underneath the partnership as long as they're the general active partner and they have those guaranteed payments, the self-employed income. So that right there is the amount at the top right here is the amount that is capped at 100 per employee. After that, you look at the payments that the employer was required to make for the group health care benefits, including their insurance premiums, and then payments of retirement benefits, the employer's contribution, not the employees, and then payments of state and local taxes assessed on the compensation. An example of that for us here in Texas would be the TWC tax that you pay per employee that the company pays. So
Terri,
what is, yep.
So Dawn's got a question. Is an owner's draw considered payroll cost?
An owner's draw considered payroll costs. So is this in particular what I'm interpreting that to mean is that this is a self-employed individual and they're drawing out, like on a Schedule C, they're doing an owner draw. The way they calculate that payroll is they're going to look at their Schedule C and look at their net income. It's line 31, and actually I'll have a slide on that, but it'll be line 31 of that self-employed individual is includable as payroll, but it's still capped at 100,000. If that did not answer the question, please resend it in and clarify. To revamp, if it's a partnership and it's an owner draw, no, it would not, like a partnership, a draw on the partners, it would not. They only specifically say the self-employment, the guaranteed payments. Since they are subject to self-employment tax, that's why they're allowing those. And then, so when you're talking about payroll costs, they specifically say that some costs do not qualify. And those would be compensation. Again, we've already mentioned this, but compensation to the individual that's in excess of 100,000, prorated over the cover period, and then also for those general partners with the self-employment income. And then the taxes imposed or withheld under Chapter 21, 22, 24. Basically, those are your payroll taxes, your Social Security, your Medicare, and the federal income tax. So you don't, there was some confusion in that because the way it's written in the bill, it's almost sounded, a lot of people, and even some banks at first, were having people back out the payroll tax withholding out of the payroll cost. Because when you read the bill, it literally, it states that. It didn't make sense. We were like, why? Because those aren't the, those are actually the employee's money. That's their withholding that's getting sent to the government. But that's how the bill kind of read. Well, they came out with guidance and they said, no, we're basing it on the gross. So, but what this in particular is saying that you can't use, because when I think of payroll costs from a tax perspective, obviously the employer pays payroll, they match the Social Security and the Medicare. Well, you're not allowed to use that match that the employer pays as part of these payroll costs, only the gross wages for that. And then if that employee's principal residence, again, is outside the United States, you can't use that person. And then also the qualified sick leave wages. One of the first acts that came out during the whole COVID was Families First Coronavirus Response Act. And it offers credits for some of the sick leave wages and then also family leave wages for those families that have, for one reason or another, they have to stay home. Like if their kids are home from school and they have to stay home with the kids. So if the employer is getting a credit for that, they can't use that same amount paid that they're getting the credit for as part of their payroll costs here. It would be double dipping. So you have to be careful not to do that. One thing I didn't put on here, but there was a lot of confusion at first too. A lot of people were saying that payroll costs, it sounded like that they were going to include the subcontractors basically. Well, they came out and they said, no, payroll costs do not include payments like 1099, that you would issue 1099s to people. And the reason they came out and said that that doesn't qualify is because those subcontractors can go apply for their own PPP loan under the stipulations because they're self-employed, they're an independent contractor. So if they gave it to the top company paying it and then they give it to the bottom person, they'd be giving it out twice. Okay, and then so when you're looking at payroll costs for the individual's self-employment income, we kind of touched on this before. they use their net income as reported on the, and it's very specific. It's as reported on your 2019 Schedule C, line 31. That's their personal compensation. So if their 2019 return has not been filed yet, they are allowed to provide a draft of that Schedule C to the bank to show, and that will be accepted by the lenders to show what that is. And that same 100,000 limitation applies here. So now we've figured out the maximum loan amount. You've put in your application. I will tell you, everybody's been a little different with this. I've seen it through clients all over the board. Some of them hear back the next day, and some of them it takes 4 or 5 days to hear back. But once that loan has been approved, the lender, according to the stipulation, is supposed to have 10 days to fund the PPP loan to the taxpayer. The funding date is very critical because that, according to the guidance, that funding date is when your 8-week period starts for the loan forgiveness qualifications. Again, there was uncertainty here, so if you hear people talk about, no, you get to choose your 8-week period. At first, the bill was written like that. It made it sound like you were gonna get to choose when that 8-week period was gonna, like the applicant would be able to choose when that was. But they came out with guidance, and it's very clear that the 8-week period starts the day those funds hit your bank account. That's when the 8 weeks starts for the loan forgiveness. So now I've been talking about this loan forgiveness, that it's so great. So now let's talk about why it's so great. So as of today, the further guidance is still expected. You know, I keep mentioning that we got all this guidance about the maximum loan calculations. Well, we're expecting the same to come out on these loan forgiveness calculations, because it's not very clear. There's a lot of room for interpretation, and they really need to clarify some questions that are out there. If they clarify these, some of these calculations could drastically be affected. So I'm just suggesting that the borrowers should remain diligent. They need to make sure that they're looking at the most up-to-date guidelines. Like I said, at the end of this slideshow, I have a link to the U.S. Treasury's website, and that's where they end up putting all of these interim rules and the facts. And they're really good on the facts, the frequently asked questions. They update it almost every day, and they'll tell you which questions they like. If for yesterday, they would say, okay, question number 20 was added on 4/16. I'm just making that up, but that's what they tell you which one was added which day. So they've been good about keeping that up to date. Okay, so on the loan forgiveness, it's an 8-week covered period, and it begins on the loan funding date. So the eligible recipient would be eligible for loan forgiveness for the amount equal to the following costs incurred and payments made during the covered period. So I put that in quotes because that's one of the things that we're not sure of. The way it reads, it says costs incurred and payments made. So was that intended to be like that? Because from everything that I'm reading, really you should make those payments out. So I'm not, you know, there's a little bit of vagueness in there. So I think that's one of the things. Actually, there's another professional who writes for the, oh, forgive me, I just blanked on where he writes for, but I think it was Forbes. The article came out a couple of days ago, or maybe it was yesterday. Tony Nitty, that was a really good article that he actually was pointing out some critical questions that they really do need to answer regarding these loan forgiveness terms. So of the funds that you were granted that hit your bank account, no more than 25% of that loan can be spent and attributable to non-payroll costs. So we've talked about what the payroll costs were. The non-payroll costs would be, I quickly mentioned them at one point, was it's your rent, your utilities, and any kind of debt that was incurred prior to 2/15/2020. But again, some of the bill, there's just some uncertainty with all this. So I wish I could say everything with assurance with this, but as it reads right now, it's the interest paid on the debt payments for debt that was incurred prior to February 15th of 2020. So again, you can only use 25% of the funds for that. The other 75% needs to be used for the payroll cost, because again, the big thing about this bill is they want to get the money to the people, to the employees. They want to keep them getting their money. So if the businesses get these loans and they don't give them to their employees, it's okay. I mean, it's okay as far as you're not going to get, it's not illegal to do that. You're just not going to get the debt forgiven if you don't pay 75% of it to these payroll costs. And the loan forgiveness amount that's calculated, so if you spend more than you got the loan for, you can't exceed the principal. You're not going to like get money back. So, and again, there are additional reduction stipulations for the number of employees, full-time equivalents, and then the salary amounts paid. Because you got to remember, this loan came out after some people had already started possibly laying off or furloughing people. So they made a stipulation about the number of employees that have to be there, and then also the salary amounts that have to be paid during the covered period. And we're going to talk about that in depth because they could foresee people looking at the salaries. Basically, let's say you have somebody making over 100,000 and you just want to keep your numbers up there. You could let somebody go that made 100,000 and then hire somebody who only made 50,000. Well, they recognized that that was going to be an issue and they didn't want it to be, so they put in that salary amount cap in there as well. And then if the borrower received the $10,000 EIDL advance, that amount reduces the loan forgiveness. So we're almost there, a couple more slides. First, I wanted to talk about the reduction of employees. If your number of employees dropped, then a portion of that loan might not be forgivable. Here are the rules that you have to look at. You have to determine what your average number of employees were during the following 2 periods, and you pick the lower number. You want it to be the lower number because that's the number you have to keep, you have to maintain during this 8-week period. You look from 2/15/19 to 6/30/19, and then 1/20/20 to February 29th of 2020. And I'm going to do an example on the next page. Then you look at the number of FTEs, full-time equivalents, employees during the 8-week covered period that you're in right now. The amount of eligible forgiveness is reduced by multiplying your loan proceeds by the quotient of the company guideline less those paid during the covered period divided by the company guide. I did an example because I was just like, okay, you can't follow that. So here's the example. You have an eligible forgiveness amount of $618,000. Your number of average employees during the 8-week period of forgiveness was 48, so it's dropped from this 53. The comparison period, you had 53 employees. So the total, the eligible forgiveness has to be reduced based on the following. You would do the 618 times whatever your difference was, the 53 minus 48 over the 53. So you have to reduce your loan forgiveness eligibility by that 58,277.40. So the remaining amount that would be able to be forgiven is the 559,722. So on that amount that can be forgiven, if you still do the rest of the stuff, you can get that forgiven. It just means you have to repay that 58,277. And again, there are no prepayment penalties, so you can repay it right after the 8 weeks if you wanted to, and you would just owe the 1% on that amount, the 58,000 that couldn't be repaid. Again, we're still expecting further guidance on this, so this calculation could change if the guidance comes out and it states something different. Then you also have to look at your salary and wages. The total reduction of the salary and wages during that 8-week period, if the employee earned less than $100,000, and they specifically say that the employee earned less than $100,000, so we're not sure if that means you have to look at people that made over $100,000. That's one of the questions. Or do you just use the cap out of $100,000 for everybody? You can't drop their salary by more than 25% when you compare it to the most recent quarter before the 8 weeks began. So if you got funded, like on 4/15, then and the employee that we're talking about was paid $20,000 for the first quarter of 2020, then you would need to pay them at least $9,230 during that 8-week period. And then I show the calculation below so that you would be able to get the full loan forgiveness. Because it'd be the $9,230.77 divided by the 8 weeks, multiply it by 52 weeks in a year, that comes to $60,000 was their annual salary. And then of course, remember they had $20,000 right there for the first quarter. So their annual salary there was $80,000. So basically your reduction is only 25%, and that's allowed. You can still get your full loan forgiven as long as you don't reduce their wages below that. If there's an amount that is not eligible for loan forgiveness at the end of the 8 weeks, the borrower would have the option to repay that amount. Remember, the option to repay it right away is what I was saying. I probably should have added that. You have to repay it if it's not forgiven. Remember, there are no prepayment penalties, and that related interest is still only 1%. The 1% is only due on the amount not forgiven, because that's the amount that's actually still a loan. You can take up to 2 years to repay that. Keep in mind, the maximum loan amount that was calculated was based on 2.5 months for the qualified payroll costs. The loan forgiveness period is only 8 weeks. And the stipulations that no more than 25% of that can be non-payroll items. The borrowers really need to analyze it carefully up front so that they can see if there's a way for them to assure they get their maximum loan forgiveness. Because as you can tell, we're dropping from 2.5 months to 8 weeks, and you might end up having an amount that's not forgiven in there if you're not careful. And these are the links that I was talking about. So there's a link I have here for the actual bill, which you can totally enjoy. I think it's like 800 pages. And then this link right here is to the website that has all of the updated tools for the Department of the Treasury. And then the AICPA also has some really good tools. They said they're gonna put out a PPP loan forgiveness calculator out there. When that's out there, that'll be very helpful. So I wanted to put that. And then, of course, the Woodlands Area Chamber of Commerce, they also have COVID-19 updates on their website. And then our company also, if you look at our news and events, we put out updates as well as they come out. So you can also look there for guidance. And I know there's a lot of companies out there that have guidance all over. So you just gotta be diligent and look at the web. And if anybody has any questions after this, if for some reason, we're gonna have a little bit of time right now, but if for some reason I can't get to them, here's my contact information and you can surely reach out. That's it. Any questions? I know it was very exciting, but it's very relevant right now.
Thanks, Terri. Do we have any questions for Terri? I know John was putting some questions into the chat. Any additional questions? All right. Well, I guess everyone got a great detailed understanding of the PPP loan. And since we are talking about that, I wanted to go ahead and say what we have coming up. Let me see if I can. So Yesterday, we had a meeting with Senator Cornyn and Tim Jeffcoat. He is the District Director of the U.S. Small Business Administration here in Houston. And they just gave an update on all federal loans, explaining it just like Terri did this morning, going over the CARES Act. Senator Cornyn did mention that 2.4 million and recover grants have been allocated to Montgomery County. So that, I thought that was interesting. They also said that Governor Abbott is issuing more testing, and he's asking the federal government to also help in that need as well. If you want to get the whole full meeting, it was really great information. Please visit our YouTube channel. It's the Woodlands Area Chamber of Commerce, and that's the name on the YouTube. Then also, the chamber as a whole is trying to do as much resources and assistance that we can do for our business community. I know that you have seen some of the initiatives on Facebook, working with some of our restaurants and healthcare, kind of giving that information, but as well as the Woodlands has a resource page for all these loan information, whether it's federal, state, or even local assistance. That gives you a whole detailed information. When you click on it, it also directs you to the application. So if you have not looked at our resource page, please look at it. As soon as you go onto our website, it's the COVID-19 resource page. You just click it and you have all the information that you need. And then lastly, we have today at 10 a.m., which will begin shortly. So if you don't have another meeting, I would suggest you going in. The Woodlands Area Chamber collaborates with Woodlands Online for a podcast. It's called Between the Trees. And the topic is going to be COVID-19, stimulus loans, payments, and cybersecurity. Again, that's going to be today at 10 a.m. live on Facebook, on the Woodlands Area Chamber Facebook. And it's going to be with Ray Sanders, Executive Vice President of Woodforest Bank. So we definitely would like for you to get involved and see all the resources that we're providing for you guys. And hopefully, if you have any questions, we can direct them to the right person to get the answers that is needed. I just want to tell everyone, thank you for taking the time for participating in our back meeting. I know this is a different setting. I hope the information was still very worthy. And I think Terri did a great job today. So